Well, hello, this is our review of Chapter 9. In Chapter 9, we're going back to high-level overview tests. However, here we are comparing the current period to a prior period. The last time we looked at high-level tests that did something similar was Chapter 2, and there we were just assessing the reasonableness of the current period. Now, we have a number of ways that we normally do these comparisons. We are going to focus on the third one. Let's just go and have a look. The first one that commonly gets done is what is called a horizontal analysis. We compare last year to this year, and we'll do something like saying this is a percentage decrease or increase or something like this. This was a small disaster that the company reported. You can see cost of sales going from that number to that number, a huge increase with a sales decrease. A horizontal analysis would pick up that things are terribly wrong here. Vertical analysis is where we let me go back, we would convert this to 100%, and then we would calculate the percentages going down here, this as a percentage of that, and we would compare the percentages and see whether our percentages have changed, and that would take into account something like growth or a lack of growth. If we did the vertical analysis with a balance sheet, we would make total assets equal to 100%. Then we would calculate all these numbers as a percentage of this, and we would compare the prior year to the current year. So horizontal and vertical analysis would be a good way to start. The next way that we would do this is we would look at the analysis of the elements of a balance. And so in the balance sheet that we saw before, we saw accounts receivable, and this would just be where we would compare the look and feel and the makeup of the numbers, the individual inventory numbers or the individual accounts receivable numbers, prior period compared to this period. Last one is just a hodgepodge of ratios, and this is indeed what auditors do as well. What they do is we'll calculate the current ratio, the quick ratio, asset turnover, and the like. We're going to focus on this one here, an analysis of the elements of a balance. So, we've seen descriptive statistics before. These are generally graphical and numerical measures that are used to summarize and interpret the properties of the data set. Numerical measures, we're going to talk more about that, and graphical measures will be our familiar histogram and first two-digit test. So, we are going to use in this chapter descriptive statistics to help us to assess whether the data contains large-scale fraud or errors, or whether there has been a large change in the environment. Auditors are required to know and understand their client's business. Now, our descriptive statistics will be broken up into three categories. The first one is simply an overview of the data. The next one is measures of central tendency. This would be things like the average. And the last one would be the variability or the spread of the numbers. How spread out are they around the mean? So let's have a look at an example here. This is the purchasing card data. This is the purchasing card for 2011. The purchasing card data for 2012. And so what we would do is we would put these values in the two columns, we would calculate the changes, and we would want to look at large changes in both percentage and in absolute terms. We want to assess whether something is possibly wrong, and we want to assess whether there has been maybe a change in the environment. Well, what we can see is 2011 to 2012, we have a huge jump both percentage-wise and in dollars. The number of records actually went down. The average went up, and that makes sense from what we've just seen before. We can actually calculate whether we have a statistically significant difference between those two means. The median, the central value, we've done these before. The mode, no change. We're looking at the minimum. 25% of the numbers are less than this. 75% of the numbers are less than that, and we can see that what's happened here is the maximum has taken a leap upwards. The range which is minimum to maximum, has taken a leap upwards as well. And the standard deviation is telling me that there's a much bigger spread to these numbers here than there was before. I can calculate whether there is a significant difference between the variances, which is the same as the standard deviation, and I have the test used, and indeed it tells us that the standard deviation has changed significantly. We've dealt with skewness before when we did the histogram. The data is, financial data is usually not normally distributed, and this is off the charts, telling us that this is not that familiar bell-shaped curve. So, in addition to that, I will also do a histogram, and indeed, it's a little, we have to do a little careful look here, but when I look at the 2,800 plus category, I can see that in 2012, this bar has definitely gone up more than that bar, and this is a terribly important bar. These are the high value items. I can look again at the first two digits, and I would want to compare these two. And again, the one that jumps out of the page and jumps out for me is I can see a difference in the 50s, went up, and I can also see a difference in the double nines, whereas we were maybe 1.5 times Benford. Here it looks like we are more than 2.5 times Benford. And indeed, if you go back to the earlier examples, you will see that we had a reasonable number of double nine transactions that were just below 100,000. This was an old application, and I enjoyed doing it when I did do it. Again, this is payroll for a company, February 18th, first two digits, February 25th, first two digits. We can tell that something has changed from here to here. And indeed, what did end up being transpiring was that this was one side of the country and this was the other side of the country. And what the company did was they paid the western half 1 week and the eastern half another week, so that each half got paid every 2 weeks, but they flipped them around. So this does tell me that there were two differences between the two halves. Over here, I talk a little bit about test data and training data. And when we have something called a supervised method of fraud detection, we have training data, which is where we know what the fraudulent transactions were. And we try to develop some formula which identifies the fraud numbers in the training data. And then we will apply that same formula to the test data and see whether we got the answers sort of right. And this is, they talk about debit and credit card transactions. Both of them are the same, and they are very un-Benford. And indeed, for normal everyday debit and credit card transactions, this is indeed a very strange list, because we expect low digits to be near the top of this page. It's very un-Benford. And what we can see is we have matches across almost until we get to here. And then the differences are only small. So instead of the training data maybe being the first 6 months of the year and the test data being the last 6 months of the year, I think what happened was they took the entire year and they almost split it in half and called half training, half test data, which is why these things look so close together. This was another example that I included, and I enjoyed it. And I looked at shopping data, and the details are given in the chapter. And I simply wanted to know whether the people that came shopping early spent more or less on average than the people shopping late. Indeed, what I could simply do is I could simply do the calculation. I can calculate the average, and I can see the average for the early was 180 and the average for the late was 199. So this tells me that the later people do spend more on average. However, I thought I would just do an histogram and do a comparison. And here we can see early, this is the low interval, and the low interval is higher. I have more low numbers early than what I have late, and this at least graphically confirms what I suspected and what I calculated using numbers. I like the Rita Crundwell case, and Let's see what it's all about. Rita was appointed as the Comptroller-Treasurer at the City of Dixon at the age of 30. She did a nice job. On December 18th, 1990, she opened up a secret bank account in the name of the city, but which the city didn't know about. What she did then was she transferred money from the bank accounts that the city knew about to this special RSCDA account, and then she simply took money from the RSCDA account and spent it for herself. So here's a check going from the city to RSCDA. This is a check being written out of RSCDA for her personal expenses. She did this repeatedly, and this was a large-scale fraud. She was in charge of picking up the mail. She was in charge of distributing the mail to everybody. And indeed, she had to keep this account secret. And as long as it was secret, she pretty much did and could do what she liked. She did the transfers over and over again. And indeed, this is the RSCDA account. And we can actually see withdrawals. And we can see that there were deposits over here. The deposits are fraudulent numbers coming in, or at least fraudulently obtained numbers coming in from the city. And this became large. The personal expenses were for her horse farm, horses, lavish lifestyle, amazingly nice vehicles, horses, a lavish lifestyle, and really nice cars, RVs, and the like. This was her motorhome. I seem to remember that this motorhome cost 2.1 million, and when they went to sell it, they actually really struggled to find anybody in the United States of America that would pay anything close to 2.1 million for a motorhome. I think they got around 750,000 when they sold it. The city was very short of cash because she was stealing like crazy. She told, and they have some anecdotes here, she told Michael in the city street department, if you know where the money tree is, I'll give you a dump truck. She repeatedly turned down requests for valid city expenses, and she did so knowing that she had been stealing over a period of 22 years, $53.74 million. She went away on vacation. She took an extra 12 weeks of vacation, and it was during that extra 12 weeks of vacation that her scheme was discovered. She was well liked, at least until the day she was caught. People used words like sweet as pie, the nicest person in the world. This was her Florida holiday home. And indeed, people that earn $83,000 a year really don't have holiday homes in Florida, and definitely not ones that looked like that. When she got caught, she was apparently very calm. She had allowed an interview to take place, and she admitted that she may have taken 10 million. Actually, if somebody does even a small confession like that, it's a wonderful start to the investigation. They have a confession, the dollar amount is wrong, but the confession has indeed started. So, sentenced to 235 months. If you do the arithmetic, 240 months would be 20 years. She owes the city 53.74 million, and it says release date October 2029. They made a movie. The movie is called All the Queen's Horses, and indeed it's a YouTube movie. You can go and watch it. I enjoyed watching it. It's a really nice documentary, a little over an hour if I remember correctly, and nicely done. Well, I saw this in her Pacer account. At least those are the court records. And what Rita would like to do now is be released from prison. There we go. I have filed for compassionate release today. This is April 22nd, 2020. She talks about the Attorney General, she talks about response to COVID-19, and she talks about why she feels she should be released. It's a nicely written letter. And at least what I find as well, when it comes to fraudsters, these are quite competent people. It's not going to look like the scrawl of somebody that can't write. She did the job. She probably did the controller job very nicely. And she can write nice letters. So, she talks about the movie, All the Queen's Horses, and she says recently sold it to Netflix. The lady that did the documentary, All the Queen's Horses, recently sold it to Netflix. She's wrong here. Recently sold it to YouTube. But let's not split hairs. She talks about interest in doing a Hollywood movie. And right at the bottom, she does a few tricks with numbers. She says, we were told today that the Bureau of Prisons will not look at anyone, meaning give any a release, unless they have completed 50% of their original sentence. She says because of her age, under the new directive, she's only required to serve 2/3 of her sentence. So, if they based the 50% on 2/3, she would qualify. But unfortunately, basing it on the real sentence would make her short of being considered. It is interesting that Rita appealed her sentence. So I can see absolutely no remorse from that woman. After she was sentenced, she wanted to appeal. She felt that the sentence was too harsh. So we have an awful lot to calculate. We have the measures of central tendency, we have the variability in the data, we have the ranges and the like, and the tool of choice here is Minitab. Minitab is easy to use. We would actually put the dollar values in one of two columns. We would use statistics up here, display descriptive statistics. We would check which ones we wanted, and Minitab would run all this very, very smoothly and would do a great job. If the data set was massive, too massive to sort of think that we should put it in a spreadsheet, and maybe too large for Minitab's capabilities, we can go on to SAS. And indeed, SAS has proc means, proc standing for procedure, and SAS would do an excellent job with an execution speed that would be absolutely amazing. I have no doubt that R could do it as well, but personally I haven't tried. We only have space in the book for so much. In this case, Access is not well suited to running all of these descriptive statistics, and with Excel we'll get most of them, but we will still fall a little short. This is what the SAS output looks like, and of course with all these programs now you can simply send something out, export it to Excel, no problem, and then reformat it, and we have a beautiful, nice table that we can present to management. So, what we do, we compare the current period to the prior period, but I'm looking at the details, and I want to know whether these numbers have got the same look and feel. Large changes could signal large-scale fraud or errors. We have a table of numeric statistics, we have the overview, the central tendency, and the variability sections. We have the two graphs, and I would recommend histogram and the first two digits. And the interesting thing with the first two digits is I end up calling this my law. And so what we would do is we would use the prior period as my expected distribution. Instead of Benford, I would use the prior period as my expected distribution, and then compare the current period to the prior period. And this is a new concept, a new way of thinking about the digits and Benford's law. I compared the training and the test data set, and it was a near perfect match, suggesting to me that this data set was randomized and sliced in half. The grocery store, I used a graph to at least show that there was a difference between the early shopping and the late shopping transactions. Why do we talk about the Rita Crundwell scheme? I do that because those transfers were so large to the RSCDA account, and they did vary from year to year, that running descriptive statistics on the ledger payments, on the bank payments, running descriptive statistics on some of the accounts, I think might have made this fraud detectable before it got to $53.7 million. And it was in fact detected by mistake. So the aftermath here is that they did sue the auditors for negligence, and there was a settlement from the auditors and there was a settlement from the bank. An analysis of the bank account withdrawals in the Rita Crundwell case might have shown that the descriptive statistics changed from significantly, possibly drawing attention to her fraudulent transfers. And so on that note, we have covered, we've reviewed Chapter 9 and Chapter 10 coming up next.